Your to-do list is a lie. It's a comforting, well-organized, neatly written lie. It presents itself as a tool of productivity, a map to your goals. But in reality, it is a graveyard of good intentions. It is a museum of mediocrity, where dozens of decent ideas are lined up in neat little rows, none of them ever receiving the ferocious, single-minded attention required to become truly great. This isn't a flaw in your character, it's a flaw in the system you've been taught. The belief that progress is the sum of many small, completed tasks is one of the most destructive myths in the world of achievement, whether you are an entrepreneur building a company or an investor building a portfolio. True, life-altering success doesn't come from doing 25 things reasonably well. It comes from doing 5 things with a level of excellence that borders on the sublime, while having the courage, the sheer, brutal discipline to let the other 20 burn. This is the secret that separates the architects of empires from the diligent managers of the status quo, and no one in modern history has architected a greater financial empire from a smaller starting point than Warren Buffett. The world sees him as a stock picker, a financial wizard who deciphers balance sheets and annual reports. But that is a profound misunderstanding of his genius. Buffett is not a stock picker, he is an idea eliminator. His true superpower is not the ability to find good investments, it's the ability to ruthlessly discard them. At the core of his multi-billion-dollar enterprise, at the heart of his entire philosophy, is a simple two-list system. A system so powerful and so counterintuitive that it feels like a violation of everything we've been taught about productivity and ambition. It's a system designed to force absolute world-class focus. It is the story of how to weaponize the word no. This is the story of Buffett's 25/5 rule, a principle of priority management so extreme it can transform not just your investment strategy, but the entire trajectory of your life. It is the key to preventing the single greatest threat to your financial future, the clutter of your own ambition. Prepare to unlearn a lifetime of bad habits. Prepare to declare war on mediocrity, because the path to extraordinary returns is paved with the ghosts of good ideas you had the strength to ignore. The story doesn't begin in a boardroom in Omaha, surrounded by financial analysts and mountains of data. It begins, as many of Buffett's most profound lessons do, in a moment of quiet conversation, thousands of feet in the air. For a decade, a man named Mike Flint had a unique vantage point on the world of Warren Buffett. He was Buffett's personal pilot. Flint was ambitious, intelligent, and deeply respected the man he flew around the country. He saw firsthand the CEO mindset in action, the relentless focus, the quiet contemplation that preceded monumental decisions in capital allocation. But like so many of us, Flint felt his own career was a collection of scattered goals. He wanted more, but the path was unclear, diffused by a multitude of aspirations. One day, during a long flight, he and Buffett were discussing Flint's career priorities. It was a conversation born of proximity and trust. Flint, seizing the opportunity to get advice from arguably the greatest capital allocator in history, laid out his professional ambitions, his dreams, his long list of things he wanted to accomplish. Buffett listened, patient as ever, as the list grew. Then, he stopped him. He proposed a simple, 3-step exercise, an exercise in personal development that would become the stuff of legend. First, Buffett said, the calm of his voice cutting through the drone of the jet engines, I want you to write down your top 25 career goals. Everything you want to accomplish in the coming years. Don't filter, don't edit, just get them all down on paper. Flint, eager and diligent, took a notepad and began to write. He listed promotions he wanted, skills he wanted to acquire, ventures he dreamed of starting. He filled the page with the raw material of his ambition. It was a list of good things, a list of potential. After some time, he presented his completed list of 25 goals to Buffett. Buffett nodded, looking it over. Good, he said. Now, for the second step. I want you to review that list carefully. Spend some time thinking about each one, and then circle the 5 that are the most important to you. Not just important, Mike, the absolute top 5. the ones that represent your deepest purpose, the very core of your professional life. This was a more difficult task. It required introspection and sacrifice. To choose 5 meant, implicitly, to demote the other 20. Flint spent a long time deliberating. He weighed each goal, imagined the future associated with it, and felt the pull of each ambition. Finally, with a sense of clarity, he drew a circle around his 5 most crucial objectives. He handed the list back to Buffett, proud of his refined focus. "Excellent," Buffett said, a slight smile on his face. "You now have 2 lists. You have the 5 items you circled. That's list A. And you have the 20 items you didn't circle. That's list B. You know what to do with list A. You need to get to work on it immediately. These are the things that deserve your time, your energy, your focus." Flint nodded enthusiastically. This made perfect sense. This was the core of priority management. But then came the question that would change his entire perspective. "But Warren," Flint asked, "what about the other 20 things on list B? They're still very important to me. I want to accomplish them too. So what's the strategy for those? Do I work on them intermittently when I have spare time? Do I pursue them on the weekends?" Buffett leaned forward slightly, his expression turning from avuncular to intensely serious. The folksy charm was gone, replaced by the steely gaze of a man who understands the brutal calculus of success. And he delivered the punchline that forms the very foundation of his philosophy. "No," Buffett said, his voice firm and unwavering. "You've got it all wrong, Mike. List B is not your work on it later list. It's not your second priority list. Those 20 items you didn't circle, they are now your avoid at all costs list. No matter what, these things get none of your attention until you've succeeded with your top 5. They are the enemies of your success. They are the distractions that will prevent you from ever achieving the goals that matter most." In that single breathtakingly counterintuitive piece of advice, Buffett revealed the secret engine behind his empire. The path to greatness is not paved with a long list of accomplished tasks. It is carved out by the aggressive, relentless, and unapologetic elimination of distractions. The 20 other goals on Flint's list weren't bad ideas. They were good ideas. They were seductive. They were interesting. And that is precisely what made them so dangerous. They were good enough to distract him from the great. This is a profound insight into the human condition, one that is explained perfectly by a psychological principle known as the paradox of choice. In the early 2000s, psychologist Barry Schwartz published a groundbreaking book that explained why more is often less. The conventional wisdom, particularly in a consumer society, is that freedom is maximized by maximizing choice. More options for jam at the grocery store, more television channels, more potential career paths. All of this is supposed to make us happier and more fulfilled. But Schwartz's research revealed the opposite. When presented with an overwhelming number of options, human beings tend to experience 2 negative outcomes: decision paralysis and decreased satisfaction. First, paralysis. A famous experiment conducted by Sheena Iyengar and Mark Lepper demonstrated this perfectly. They set up a tasting booth for high-quality jams in a gourmet market. On one day, they offered 24 different varieties of jam. On another day, they offered only 6. The booth with 24 jams attracted more onlookers, but here's the critical finding. People who saw the large display were 1/10 as likely to actually buy a jar of jam as people who saw the small display. The sheer number of choices was overwhelming, leading most people to simply walk away. They were paralyzed by the options. This is exactly what happens with our goals, our projects, and our investment ideas. A list of 25 good ideas feels productive, but it's a recipe for paralysis. We dabble in one, then get distracted by another, then feel guilty for neglecting a third. We spend so much mental energy just trying to decide what to focus on that we never achieve the deep, sustained focus required for a breakthrough in any single area. Second, even when we do manage to make a choice from a large array of options, we tend to be less satisfied with the outcome. Why? Because the opportunity costs are magnified. When you choose one jam from a selection of 24, you are keenly aware of the 23 jams you didn't choose. You start to second-guess yourself. Maybe the apricot was better? The boysenberry looked good. The pleasure of your choice is diminished by the ghosts of the alternatives. Now apply this to your investment strategy. If you have a portfolio of 30 stocks and one of them does exceptionally well, your satisfaction is tempered by the 29 that are lagging. You obsess over the losers, wondering if you should have put more money into the winner. The mental burden is enormous. Buffett's 25/5 rule is a brutal but effective antidote to the paradox of choice. It's a forced mechanism for decision and a pre-commitment to satisfaction. By identifying the top 5, you are making a conscious, deliberate choice. By creating the avoid at all costs list, you are giving yourself permission to ignore the opportunity costs of the other 20. You are freeing up vast reserves of mental energy that would otherwise be wasted on second-guessing and what-if scenarios. You are trading the illusion of infinite options for the real-world power of absolute focus. This isn't just a theory. It's a practical framework you can apply to your own life right now, long before you even think about applying it to stock picking. Let's call it the career audit. It's a blueprint for translating this abstract principle into concrete action. Step 1 is the brain dump. Just as Buffett instructed Mike Flint, take out a piece of paper and write down the 25 most important things you want to accomplish professionally in the next 5 to 10 years. Don't censor yourself. Do you want to get a specific promotion? Learn to code in Python, start a side business in e-commerce, write a book, become a public speaker, get an MBA. Master a new language for international business? List them all. This list represents your universe of potential. It is the raw ore of your ambition. Step 2 is the core identity filter. Look at that list of 25 items. Now ask yourself a brutal question. If I could only be known for 5 of these things, which 5 would define the person I truly want to become? This is not about which 5 are easiest or which 5 sound most impressive to others. This is an act of deep self-interrogation. Which 5 goals, if achieved, would make all the others feel insignificant in comparison? Which 5 resonate with your deepest values and your unique talents? Circle those 5. This is your list A. This is your mission. This is where your executive decision-making capabilities must be focused. Step 3 is the vow of avoidance. This is the most difficult and most important step. Take the 20 items you did not circle and write them on a separate piece of paper. At the top of this page, write in big, bold letters, "My avoid at all costs list." This is your list B. These are not your someday projects. They are your enemies. They are the sirens on the rocks, luring your ship of ambition to its doom. You must now make a conscious vow to say no to them. If an opportunity comes up related to one of these 20 items, you decline it. If you find yourself daydreaming about one of them, you actively redirect your thoughts back to your top 5. You must starve them of your most precious resources, your time and your attention. The power of this exercise is staggering. It cuts through the fog of modern life. Most people operate in a state of chronic busyness, a trap that feels productive but yields mediocre results. The path of the 99% is to be addicted to activity. They pride themselves on juggling multiple projects. They wear their long to-do lists like a badge of honor. They're constantly starting new online courses, buying new books they never finish, and launching side hustles that fizzle out after a few months. They are trapped in a cycle of what Cal Newport calls shallow work. Their attention is fractured into a dozen different directions. They are like a ship with multiple rudders, each trying to steer it toward a different port. The result is that the ship simply spins in circles, its engines churning, burning immense amounts of fuel, but making no forward progress. They are busy, but they are not effective. They mistake motion for achievement. The direct financial connection of this scattered approach is devastatingly real, even outside of an investment portfolio. In the world of business and entrepreneurship, this lack of focus manifests as switching costs. Every time you switch your attention from one task to another, from working on your main business strategy to checking on a minor side project, for example, your brain has to reload the context. This takes time and mental energy. Research suggests that these switching costs can consume as much as 40% of a person's productive time. Imagine getting a 40% pay cut simply because you can't focus. That is the financial reality of the busyness trap. For entrepreneurs, this manifests as trying to serve too many markets at once, or launching too many products before perfecting one. The result is a diluted brand, a confused customer base, and a business that is perpetually starved for the resources it needs to dominate a single niche. For the professional, it means being a jack of all trades and a master of none. You become reasonably good at many things, but not world-class at the one thing that could truly accelerate your career and your income. Buffett's system, born on that flight with Mike Flint, is the ultimate defense against this modern disease of distraction. It is a declaration that focus is not just one component of success, it is the prerequisite for it. It is the understanding that the true cost of pursuing a good idea is the forfeiture of a great one. And in the world of investing, where a single great idea can compound into a fortune, this principle is not just a helpful tip. It is the first and most important law of wealth creation. The average investor believes that safety lies in numbers. They think that by spreading their capital across dozens of different stocks, they are mitigating risk. They are building a fortress against the unpredictable whims of the market. This deeply ingrained belief, this near-religious faith in diversification, is the primary reason most people achieve mediocre returns. They are not diversifying. They are, in the pithy words of Peter Lynch, diversifying. They are ensuring that the explosive gains from their few brilliant ideas will be drowned out by the dead weight of their many mediocre ones. Warren Buffett understood this psychological trap early in his career, and his first great investment serves as a masterclass in the opposite approach: radical, high-conviction portfolio concentration. It was 1963, and Wall Street was in a state of absolute panic over a company called American Express. The source of the panic was a scandal of almost comical proportions, something that would come to be known as the salad oil scandal. A New Jersey company called Allied Crude Vegetable Oil, run by a man named Anthony Tino DeAngelis, had perpetrated a massive fraud. Allied would take out huge loans using its inventory of salad oil as collateral. American Express, through a warehousing subsidiary, would issue receipts certifying that this collateral existed. The problem was, it didn't. Tino DeAngelis had devised a brilliant scheme. His giant storage tanks were mostly filled with water, with only a thin layer of valuable salad oil floating on top. When inspectors came, they saw what they expected to see. The fraud was colossal, estimated at over $175 million, a staggering sum for the time. When Allied Crude went bankrupt, the lenders who held the worthless receipts from American Express came calling. Wall Street panicked. The consensus was that American Express would be on the hook for all of it, a liability that would almost certainly bankrupt the company. The stock price was annihilated, plummeting by nearly 50%. This was a crisis of confidence, the kind of event that sends the herd stampeding for the exits. This is precisely the moment when most investors, driven by fear, would have sold any remaining shares of American Express they owned. They would have looked for safety in a basket of less risky stocks. They would have diversified. But Warren Buffett is not most investors. He saw not a crisis, but an opportunity of a lifetime. Instead of running from the fire, he ran toward it with a bucket, not a thimble. He didn't just read the panicked headlines. He did the hard, focused work that others were unwilling to do. He went out to the restaurants and merchants in his hometown of Omaha. He talked to travelers. He observed customer behavior, What he found was that the scandal, which was dominating the headlines on Wall Street, was practically invisible on Main Street. People were still using American Express credit cards. They were still cashing American Express traveler's checks. The underlying business, the powerful brand that lived in the minds of consumers, was completely unscathed. He realized that the company's ultimate liability for the fraud would be a fraction of what the market feared. The core franchise was intact and immensely valuable. So what did he do? He didn't nibble. He didn't hedge his bets. He didn't add American Express as a small position in a widely diversified portfolio. He swung for the fences. In a stunning display of high-conviction investing, Buffett invested a full 40% of his partnership's entire capital into the stock of American Express. It was a single decisive bet. It was the physical manifestation of the 25/5 rule. He had done the work, identified this as one of his absolute top ideas, and he allocated his capital accordingly. The result was legendary. As the market's fear subsided and the true limited liability became clear, the stock price roared back. The single investment generated a massive profit that would become a cornerstone of his early fortune. This story cuts to the very heart of the psychological battle an investor must wage against their own instincts. The primary enemy of portfolio concentration is not market risk. It is our own deeply rooted cognitive biases. The first and most powerful of these is herd mentality, also known as the principle of social proof. As social creatures, we are wired to find safety in numbers. If everyone around us is running from a building, our first instinct is not to stop and investigate. It is to run with them. In the investing world, this translates to a powerful urge to do what everyone else is doing. If the consensus is that diversification across 50 to 100 stocks is prudent, then deviating from that norm feels reckless and dangerous. Owning a concentrated portfolio of just 5 to 10 stocks exposes you to psychological pain. If the market is going up but one of your few holdings is going down, you feel foolish. If you owned 50 stocks, that one loser would be easily ignored. But in a concentrated portfolio, there is nowhere to hide. This fear of looking wrong, of standing apart from the crowd, pushes investors toward the comfortable mediocrity of an over-diversified portfolio. Closely related to this is the fear of missing out, or FOMO. The modern financial media is a relentless FOMO-generating machine. Every day, there is a new hot stock, a new revolutionary technology, a new can't-miss opportunity. An investor with a 50-stock portfolio can easily justify taking a small flyer on the latest trend. They can add a little bit of crypto, a little bit of a hot software stock, a little bit of an electric vehicle startup. It feels like they are participating, like they are not missing out on the next big thing. But the 25/5 rule is a declaration of war on FOMO. It forces you to acknowledge that you precisely spiritually miss out on most winning stocks. And that's okay. Your goal is not to catch every single wave. It's to catch the one or two giant waves that matter and ride them for all they're worth. This requires the immense psychological fortitude to watch other stocks rocket higher and feel no envy, no regret, because you are supremely confident in the 5 elite ideas you have chosen. The only way to build this fortitude is to have a rigorous system for identifying your best ideas in the first place. You need a blueprint for cutting through the noise. That blueprint is built upon another of Buffett's core concepts, the circle of competence. To fight the urge to diversify, you must first define the boundaries of your own knowledge. Step 1 is to define your circle. Take out a piece of paper and draw a large circle on it. Inside that circle, you must write down the industries, business models, and technologies that you understand with intimate, expert-level knowledge. This is not about what's popular or what's exciting. It's about what you know. Did you work in the banking industry for 20 years? Banking is in your circle. Are you a software engineer who understands the economics of cloud computing better than 90% of the population? SaaS businesses are in your circle. Do you run a small retail business and understand supply chains, inventory management, and consumer branding? Consumer staples might be in your circle. The key here is brutal intellectual honesty. The size of the circle is not important. Knowing its boundaries is vital. As Buffett famously said, you don't have to be an expert on every company. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. Step 2 is to generate your list of 25 potential investments only from within that circle. This act alone will eliminate 99% of the market's distractions. You will no longer be tempted by a biotech company with a promising new drug or a mining company that just discovered a new deposit, because you will have pre-committed to the fact that you know nothing about those businesses. All your research, all your mental energy will be focused on the area where you have a genuine edge. Step 3 is to apply the 10-year test to these 25 ideas. For each company on your list, ask yourself, can I, with a high degree of confidence, describe what the competitive landscape and the fundamental economics of this business will look like in 10 years? This simple question is a powerful filter. It forces you to favor businesses with durable, predictable qualities over those that are subject to rapid technological change or fleeting consumer trends. Companies with strong brands, network effects, or entrenched cost advantages, what Buffett calls a moat, are the ones that will pass this test. Speculative tech companies or fashion brands will likely fail. By the time you are done, your list of 25 will have naturally shrunk, moving you closer to identifying the truly elite 5. The antithesis of this disciplined approach is what I call the index fund mentality misapplied. Let me be clear, for the vast majority of people who have no interest in analyzing individual businesses, a low-cost index fund is the best possible investment strategy. It guarantees you your fair share of the market's returns. However, there is a class of active investors who, through their actions, create their own high-cost, inefficient, personal index fund. This is the investor who subscribes to multiple investment newsletters, watches financial news channels for hours a day, and trolls social media for stock tips. They hear an interesting idea about a software company on Tuesday and buy a few shares. On Thursday, they read a compelling article about an energy company and add that to the portfolio. By the end of the year, they own 75 different stocks in tiny, insignificant position sizes. They have created what is known as a, quote, closet index. Their portfolio is so diversified that its performance will almost perfectly mirror the market index, but with a crucial, destructive difference. They are paying much higher costs. They pay transaction fees every time they buy and sell. They pay a huge psychological cost in the time and energy spent managing this chaotic collection of stocks. And worst of all, they will pay a massive, unnecessary tax bill due to the high turnover. They have all the work of an active manager with all the results of a passive one. They have diversified their way to guaranteed mediocrity. The direct financial connection here can be illustrated with simple, brutal mathematics. Let's imagine you have $100,000 to invest. You do incredible work and identify a company that you believe will be a 10-bagger. It will increase in value by 10 times over the next decade. If you follow the 25/5 rule and build a concentrated portfolio of 5 stocks, you might allocate a full 20% of your capital, or $20,000, to this high-conviction idea. When that stock becomes a 10-bagger, your $20,000 position grows to $200,000. That single investment has doubled your entire portfolio. Now consider the closet indexer with a 50-stock portfolio. They also identify this fantastic company, but because they are spreading their bets, they only allocate 2% of their capital, or $2,000, to it. When that stock becomes a 10-bagger, their $2,000 position grows to $20,000. The gain is a mere 18% of their starting capital. It barely moves the needle. Their one brilliant insight was rendered financially impotent by their lack of conviction. The mathematics of mediocrity are unforgiving. To achieve results that are significantly different from the average, your portfolio must look significantly different from the average. And that begins with conquering the deep-seated psychological fear of standing apart from the herd. a fear that Buffett conquered in 1963 and has profited from ever since. Identifying your circle of competence and generating a list of 25 potential investments is the first step. It is the act of gathering the raw materials. The next and far more difficult step is the alchemy of turning that raw material into gold. It is the process of forging the Elite Five. This is not a matter of guesswork or gut feeling. It is a systematic, rigorous, and unemotional process of analysis that separates the merely good businesses from the truly great ones. It is the art of high-conviction selection, and the textbook case study for this art unfolded in the early 1970s with Warren Buffett's investment in the Washington Post. To the outside world in 1973, the Washington Post company looked like a troubled asset. The company had just gone through a brutal high-stakes battle with the Nixon administration over the publication of the Pentagon Papers. Its legendary publisher, Katharine Graham, who had taken over after the tragic death of her husband, was still viewed with skepticism by the male-dominated world of Wall Street. The stock market was in the doldrums, and newspaper stocks were particularly unloved. The market saw risk, controversy, and an uncertain future. Buffett saw something entirely different. He saw one of the greatest, most durable business franchises on the planet, available for sale at a price that was almost criminally cheap. He wasn't just buying a stock, he was buying a quasi-monopoly. At the time, the Washington Post was the dominant source of news, information, and advertising in one of the most affluent and powerful cities in the world. If you were a department store in Washington, D.C., and you wanted to reach your customers, you had no real alternative. You had to advertise in the Post. This gave the company immense pricing power. It had a deep and wide competitive moat. While Wall Street was focused on the short-term political drama, Buffett was focused on the long-term business economics. He did a simple calculation that anyone could have done, but almost no one did. He looked at the company's assets and earnings power and conservatively estimated that the entire business was worth at least $400 million. He then looked at the stock price. The market was valuing the entire company at just $80 million. He could buy a dollar for 20 cents. This was not a small opportunity. It was a screaming bargain, a once-in-a-generation chance to buy a crown jewel business from a panicking market. This was a clear candidate for the Elite Five. He began buying stock aggressively, eventually investing over $10 million, which became one of Berkshire Hathaway's largest holdings. Over the next several decades, that single investment would grow in value by more than 100-fold, becoming one of the foundational pillars of Berkshire's wealth. The Washington Post investment is the perfect template for what it means to have high conviction. It wasn't based on a hot tip or a complex forecast. It was based on a simple, powerful idea. Buy a wonderful business with a durable competitive advantage, run by honest and able people, at a price that is significantly below its intrinsic value. This process of selection is a powerful defense against two of the most dangerous cognitive biases that plague investors: confirmation bias and the overconfidence effect. Confirmation bias is our natural tendency to seek out and favor information that confirms our existing beliefs, while simultaneously ignoring or devaluing information that contradicts them. If we think a stock is a good investment, we will subconsciously click on the positive news articles, read the bullish analyst reports, and dismiss any negative information as, quote, market noise. The 25/5ths process acts as a powerful circuit breaker for this bias. When you have 25 ideas sitting in front of you, you are forced to become an internal critic. You cannot simply fall in love with one idea. You must pit them against each other in a brutal intellectual competition. You have to ask, is idea number 7 really a better business with a wider moat than idea number 12? Does idea number 3 really have a more trustworthy management team than idea number 21? This comparative process forces you to look for flaws, not just confirmations. The 20 ideas that get cut are not necessarily bad investments. They are simply the victims of this ruthless intellectual murder board. They are the ideas that could not withstand the scrutiny when compared to the absolute best. Then there is the overconfidence effect, our tendency to be more confident in our own abilities and judgments than is objectively warranted. In investing, this manifests as the belief that all our ideas are good ideas. The process of generating a list of 25 can inflate our ego. Look at all these great companies I found. But the discipline of forcing yourself to cut it down to 5 is a humbling and necessary dose of reality. It is an admission that, while you may have found 25 good ideas, only a very small handful are likely to be truly great. It replaces ego-driven accumulation with a process of humble, evidence-based curation. To make this process tangible, you need a practical tool, a blueprint for systematically ranking your ideas. Let's call it the Buffett Moat Scorecard. This is a step-by-step framework you can use to grade each of your 25 potential investments, forcing a level of analytical rigor that makes the elite 5 naturally rise to the top. The scorecard has 4 main categories, each scored on a scale of 1 to 10. The first category is the durable competitive advantage, or the moat. This is the most important factor. How protected is this business from competition? The sources of a moat are few. Is it a network effect, where the service becomes more valuable as more people use it, like a credit card company or a social media platform? Is it intangible assets, like a powerful brand name that commands premium pricing, or a patent that protects a key technology? Is it high switching costs, where it is a major pain for customers to switch to a competitor, like the relationship a business has with its core banking partner? Or is it a cost advantage, where the company can produce its goods or services cheaper than anyone else, allowing it to either win on price or earn higher margins? A business with no discernible moat gets a score of 1. A business with a deep, wide, and growing moat, like the Washington Post in its heyday, gets a 10. The second category is management quality. Are the people running this company brilliant capital allocators, or are they empire builders who overpay for acquisitions? You can determine this by reading their shareholder letters and studying their track record of investments and buybacks. Do they have integrity? Are they transparent with shareholders, or do they obfuscate and make excuses? A management team that is self-serving, promotional, and has a poor track record of creating shareholder value gets a 1. A team like Buffett's at Berkshire Hathaway, known for its rationality, integrity, and long-term focus, gets a 10. The third category is financial strength. A great business should not require huge amounts of debt to operate. Look at the balance sheet. Is the debt level manageable relative to the company's earnings? Look at the returns on capital. For every dollar the company invests back into its business, how much profit does it generate? A company that is heavily indebted and earns low returns on its capital is a fragile, low-quality business. It gets a low score. A company that is self-funding, has a pristine balance sheet, and generates consistently high returns on invested capital is a true compounding machine. It gets a high score. The fourth and final category is the margin of safety. This is the difference between the intrinsic value of the business, what it's truly worth, and the price at which its stock is currently trading. This is where your valuation work comes in. If you calculate a business is worth $100 per share and it's trading at $95, you have almost no margin of safety. It gets a 1. If that same business is trading at $50 per share, you have a massive margin of safety. It gets a 10. This protects you from being wrong in your calculations and from the unpredictable swings of the market. Once you have scored each of your 25 companies across these 4 categories, you simply add up the scores. The 5 companies with the highest total scores become your elite 5. This is your high conviction list, backed not by emotion, but by a systematic process. The opposite of this disciplined approach, the path of the 99%, is what can be called story stock investing. This is the practice of buying a stock based on a compelling narrative, rather than a sober analysis of its business fundamentals. The story might be about a disruptive new technology that's going to change the world. It might be about a charismatic, visionary CEO who gives great interviews. It might be about a product that you personally love. These stories can be incredibly seductive. They appeal to our emotions, our hopes, and our desire to be part of the next big thing. During the dot-com bubble, investors bought stories about eyeballs and network effects, for companies that had no revenue and no path to profitability. In more recent times, investors have piled into companies based on exciting stories about electric vehicles, space travel, or artificial intelligence, often paying prices that bear no relationship to the underlying business reality. Story stock investing completely bypasses the moat scorecard. It doesn't ask hard questions about competitive advantages, financial strength, or valuation. It asks only, is this an exciting story? This is the path of speculation, not investment, and it almost always ends in tears when the narrative collides with reality. The direct financial connection of focusing on the Elite Five, chosen through this rigorous process, is profound, and it can be measured by a single metric: return on invested capital, or ROIC. ROIC is a measure of how efficiently a company is using its capital to generate profits. A business that can consistently generate a high ROIC, say 20% or more, is a true wealth-creating machine. By definition, the companies that score highest on the moat scorecard are the ones with the highest and most sustainable ROIC. When you build a concentrated portfolio of these high ROIC businesses, the weighted average ROIC of your entire portfolio is dramatically elevated. This becomes the fundamental engine of your wealth compounding. Think of it this way. A portfolio of 50 mediocre companies might have an average ROIC of 8%, barely keeping up with the long-term market average. A concentrated portfolio of 5 elite businesses could have an average ROIC of 25%. The difference in the growth of your capital over a decade or two is not incremental, it is exponential. This is the financial physics of how fortunes are built. It's not about finding more ideas, it's about having the discipline and the framework to identify the truly superior ones, and then betting big on them. It is the art of transforming a long list of possibilities into a short list of certainties. The first 3 stages of the 25/5 system are an exercise in addition and subtraction. You add 25 ideas, then you subtract 20 to find the Elite 5. This is the analytical part. But the 4th stage is where the real battle is fought. This is the stage of maintenance, of defense, of discipline. It is about honoring the most important part of Buffett's advice to his pilot, that the other 20 ideas are not a waiting list. They are an avoid-at-all-costs list. This is about mastering the power of no. And there is no greater story in the history of modern finance about the power of no than Warren Buffett's conduct during the dot-com bubble of the late 1990s. It is difficult to overstate the sheer mania of that period. The internet was new, exciting, and promised to change everything. A new class of companies with names like Pets.com, Webvan, and TheGlobe.com was emerging, and their stock prices were detaching from reality. These companies had no profits, often no revenue, but they had a .com in their name and a story about the new economy. Valuations soared to levels that were mathematically impossible to justify. Meanwhile, Warren Buffett and Berkshire Hathaway were being openly mocked. Their strategy of buying boring, profitable businesses like insurance companies and furniture stores was seen as hopelessly antiquated. Barron's, a leading financial publication, ran a cover story in 1999 titled, "What's Wrong, Warren?" The article questioned if the world's greatest investor had lost his touch. Berkshire's stock badly underperformed the soaring NASDAQ index. The pressure to capitulate, to join the party, was immense. His shareholders were questioning him. The media was ridiculing him. Every financial instinct honed over decades was being challenged by a euphoric market that insisted, this time it's different. Buffett's avoid-at-all-costs list at that moment was essentially the entire technology sector. Why? Because it fell outside his circle of competence. He famously admitted he didn't know how to value these companies, he couldn't predict what they would look like in 10 years, he couldn't identify a durable competitive moat in a landscape that was changing by the day. So he did nothing. He said no. He said it over and over again, for years. while watching others get fabulously rich on paper. It must have been psychologically excruciating. It required a level of discipline and self-confidence that is almost superhuman. But his commitment to his principles, his unwavering dedication to his avoid list, was absolute. And then, in March of 2000, the bubble burst. The Nasdaq crashed by nearly 80% from its peak. Hundreds of billions of dollars in speculative wealth evaporated. The new economy darlings went bankrupt, and Warren Buffett, the man who had been called a dinosaur, was revealed to be the wisest man in the room. He had not only preserved his capital during the crash, he had it available to deploy into the wreckage at bargain prices. His steadfast no during the mania allowed him to say a powerful yes during the panic. This is the ultimate case study in eliminating distractions and the strategic value of omission. The psychological force that Buffett was fighting against is known as action bias. Our brains are hardwired with a preference for action over inaction, even when inaction is the more rational course. In an uncertain situation, we feel an overwhelming urge to do something. It makes us feel like we are in control. For an investor, this bias is a portfolio killer. Watching the market every day, seeing stocks move, reading news headlines, it all creates a constant pressure to act, to buy something, to sell something, to rebalance, to tinker. The 25/5 rule, and specifically the creation of the avoid at all costs list, is a powerful system designed to short-circuit this destructive bias. It is a form of pre-commitment. By deciding in a calm, rational moment what you will not do, you protect yourself from making foolish, impulsive decisions in a moment of market euphoria or panic. You are essentially making a pact with your future self. You are creating a rule-based system that overrides emotion-based instinct. This avoid list doesn't just save you from bad investments, it saves you from the colossal waste of mental energy spent considering them. Every minute you spend researching a company that is outside your circle of competence or that doesn't meet your quality threshold is a minute you cannot spend deepening your understanding of one of your elite 5. The opportunity cost is immense. To formalize this discipline, you need to move beyond a simple list and create what is known as an investment policy statement, or an IPS. This is a blueprint, a written constitution for your entire investment strategy. It's a tool used by professional wealth management firms, but it's even more valuable for an individual investor because it enforces personal accountability. Creating an IPS is a straightforward process. Step 1 is to define your philosophy. Write it down. Are you a long-term investor or a short-term trader? Are you focused on value, growth, or a combination? What is your time horizon? What is your tolerance for risk? Be specific. For example, my philosophy is to be a long-term owner of businesses, holding them for a minimum of 5 years. I will focus on high-quality companies within my circle of competence, purchased only when they are trading at a significant discount to their intrinsic value. Step 2 is to define your criteria for the Elite 5. This is where you formalize the MOAT scorecard. You can write down your minimum acceptable scores for each category. For example, I will only invest in companies that score a minimum of 7/10 on durable competitive advantage, 7/10 on management quality, 6/10 on financial strength, and are trading at a price that scores at least an 8/10 on the margin of safety. This creates an objective, non-negotiable set of rules. Step 3, the most crucial part, is to create the avoid clause. This is the section of your IPS where you explicitly codify your avoid at all costs list. This clause should state, in writing, that you are committed to not investing your time or capital in several categories of ideas. This includes A. Any company that falls outside your clearly defined circle of competence. B. Any company that fails to meet the minimum threshold scores on your MOAT scorecard. And C. The specific 20 ideas that you generated and then explicitly cut from your list during the 25/5 exercise. You should print this document, sign it, and place it somewhere you will see it regularly. When you feel the pull of FOMO, when a friend gives you a hot stock tip, You can pull out your IPS and hold yourself accountable to the rules you created when you were thinking rationally. The antithesis of this structured, disciplined approach is the tinkerer's portfolio. This describes the investor who is in a constant state of motion. They check their portfolio multiple times a day. They subscribe to real-time market data feeds. They are obsessed with optimizing their holdings. They sell a stock that has gone up 20% to lock in profits. They buy more of a stock that has gone down 30% to average down. Their decision-making is entirely reactive, driven by the random noise of daily price fluctuations. They have no overarching strategy, no philosophy, and certainly no avoid list. To the tinkerer, every stock is a potential trade, every news event a reason to act. This constant activity, this portfolio churn, has a devastating and direct financial connection that most people fail to appreciate. The hidden tax of short-term thinking. In the United States tax code, there is a massive difference between short-term and long-term capital gains. If you buy a stock and sell it for a profit in less than a year, that profit is considered a short-term capital gain and is taxed at your ordinary income tax rate, which can be as high as 37% for high earners. If you hold that same stock for more than a year before selling, the profit is considered a long-term capital gain, and it is taxed at a much more favorable rate, typically 15 or 20%. The difference is enormous. Let's run a simple example. Imagine two investors, the tinkerer and the disciplined holder. Both invest $50,000 and, through some combination of luck and skill, manage to achieve a 20% gross return or a $10,000 profit. The tinkerer achieved this by rapidly buying and selling stocks throughout the year. Their $10,000 profit is all short-term. Assuming they are in a 30% federal and state tax bracket, they will owe $3,000 in taxes. Their net profit is $7,000. The disciplined holder achieved their 20% return by buying one of their elite 5 and holding it for over a year. Their $10,000 profit is a long-term capital gain. At a 15% tax rate, they will owe $1,500 in taxes. Their net profit is $8,500. Just by holding on, by saying no to the urge to tinker, the disciplined holder's net return is over 21% higher. Now compound that difference over a 30-year investing lifetime. The gap becomes a chasm. The tinkerer's portfolio is constantly being eroded by taxes and transaction costs, a silent and relentless drag on performance. The disciplined holder's portfolio is allowed to compound with minimal friction, protected by the power of strategic inaction. The avoid at all costs list is not just a productivity hack, it's a sophisticated tax avoidance strategy. It is the financial embodiment of the principle that often the most profitable decision is the one you don't make. The final piece of this powerful system connects all the others. It is the destination toward which focus, concentration, and discipline all point. It is the financial endgame. This is the principle that unlocks the almost magical power of compounding, transforming a concentrated portfolio from a simple collection of assets into a self-perpetuating wealth engine. To understand this, we must go back to a pivotal moment in Warren Buffett's own intellectual journey, a moment orchestrated by his partner, the brilliant and acerbic Charlie Munger. In his early days, Buffett was a pure value investor in the mold of his mentor Benjamin Graham. He was a bargain hunter searching for what he called cigar butts, mediocre businesses that were so cheap they had one last free puff left in them. He would buy a company for less than its liquidation value, wait for the market to recognize its statistical cheapness, and then sell it for a small profit. It was a successful strategy, but it was laborious and, crucially, it was not scalable. You can't invest billions of dollars by picking up cigar butts. Charlie Munger changed all of that. He pushed Buffett to evolve his thinking, to move beyond simply buying cheap companies, and toward buying wonderful companies at fair prices. The turning point was their acquisition of See's Candies in 1972. On the surface, See's did not fit the old Buffett model. They paid $25 million for the company, which was a significant premium to its book value. A pure Graham-style investor would have balked at the price. But Munger saw what the numbers didn't immediately reveal. See's was a phenomenal business. It had a beloved brand name on the West Coast, giving it immense pricing power. It required very little capital to operate. And most importantly, it gushed cash. It was a wonderful business, and they were buying it at a fair, though not statistically cheap, price. The See's Candies acquisition was a revelation for Buffett. It taught him that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. A fair company, the cigar butt, gives you a one-time profit, but a wonderful company, one of the elite 5, can be held for decades, compounding its intrinsic value year after year. The initial $25 million investment in See's has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all without requiring significant additional capital investment. It was and is a true compounding machine. This is the ultimate goal of the 25/5 system: to populate your portfolio not with cigar butts but with See's Candies type businesses. The compounding of a concentrated portfolio of such businesses is the financial equivalent of nuclear fusion. It unleashes an incredible amount of energy. But to harness this power, you must overcome 2 final psychological hurdles: our inherent difficulty with delayed gratification and our complete inability to intuitively grasp exponential growth. Humans are wired for instant rewards. It's an evolutionary trait that served us well when the primary goal was finding our next meal. But in the world of investing, it is a catastrophic flaw. The rewards of a concentrated long-term strategy are not linear. They are back-end loaded. The first few years might be unremarkable, but as the high returns on capital from your elite businesses are reinvested, the growth curve begins to bend upwards, becoming steeper and steeper. This is the nature of exponential growth. Our brains, however, tend to think in straight lines, a phenomenon known as exponential growth bias. We look at a chart and project the recent past forward in a linear fashion. This is why the early years of a compounding journey can feel frustratingly slow, and it's why so many people abandon the strategy just before the magic is about to happen. They lack the patience, the ability to delay gratification, to wait for the exponential curve to work its wonders. The 25/5 system is a structure designed to enforce this patience. By focusing on only 5 companies, you are incentivized to know them inside and out, to build a deep, unshakable conviction in their long-term prospects. This conviction is the antidote to the impatience that plagues most investors. To crystallize this mindset, Buffett offers one final powerful mental model: the punch card investor. He says, imagine that you have a punch card with only 20 punches on it, and that's all you get for your entire investing lifetime. You have to think incredibly hard about every single investment you make. This mental model is the ultimate application of the 25/5 rule. It elevates your decision-making from a casual activity to an act of profound importance. Before you buy a stock, you must ask yourself, is this business so good? Is my understanding of it so complete? And is the price so attractive that I am willing to use one of my precious 20 lifetime punches on it? This question immediately raises the bar for what constitutes an acceptable investment. It kills the urge to speculate. It forces you to say no to 99.9% of the ideas that cross your desk. Your 25 ideas are the candidates, your 5 are the ones that earn a punch, and your 20 are the ones that are so obviously not worthy of a punch that you can dismiss them without a second thought. This is the CEO mindset applied to a portfolio. Every capital allocation decision must be monumental. The antithesis to the punch card investor is the lottery ticket mentality. This is the approach taken by the speculator who spreads small amounts of money across dozens of high-risk penny stocks or speculative cryptocurrencies, hoping that one of them will be the next thousand-bagger. This is not an investment strategy, it's a gambling strategy. It is predicated on pure luck, not on a deep understanding of business economics. The lottery ticket buyer doesn't do deep research. They don't use a moat scorecard. They are buying a hope, a dream, a story. While this approach can occasionally produce a spectacular winner, it is a mathematically guaranteed path to long-term failure. because the vast majority of these lottery tickets expire worthless, eroding the investor's capital base until there is nothing left. The direct financial connection of a concentrated punch card approach is a concept Charlie Munger calls the Lollapalooza effect. This is what happens when several powerful forces all combine and push in the same direction, creating a result that is not just additive, but multiplicative. In a concentrated portfolio of elite, high ROIC businesses that you hold for the long term, you get a Lollapalooza effect of wealth creation. First, you have the high return on capital generated by the underlying businesses themselves. That's your primary engine. Second, you have the extreme tax efficiency that comes from low portfolio turnover, as we discussed. This is an accelerator, allowing more of your capital to stay in the game and compound. Third, you have the reinvestment of dividends and earnings back into those same wonderful businesses, either by the company's management or by you. This adds more fuel to the fire. And fourth, an often overlooked factor, you have the compounding of your own knowledge. As you spend years studying just a handful of companies, you become a true expert. Your understanding deepens, your conviction grows, and your ability to make rational decisions during times of panic increases dramatically. These four factors, high returns, tax efficiency, reinvestment, and knowledge, combine to create a virtuous cycle, a wealth-generating engine that is far more powerful than the sum of its parts. This is the physics of how true, generational financial freedom is achieved. It's not through frantic activity, diversification, or chasing hot tips. It is through the brutal, relentless, and systematic application of focus. It is the final promise of the two-list system, that by having the discipline to do less, you will ultimately achieve infinitely more. You have made it to the end. And by investing your time here, you have done more than just watch another video. You have acquired a powerful mental operating system for radical focus. You now possess the 25/5 rule, a framework for identifying what truly matters, and a weapon for eliminating the distractions that seek to sabotage your success. You understand that your avoid-at-all-costs list is more important than your to-do list. This is a tool that can fundamentally reshape not just your portfolio, but your career, your business, and your life. It is the first principle of effective capital allocation, whether that capital is measured in dollars or in minutes of your day. But this system, as powerful as it is just one crucial pillar in the grand architecture of an investor's mind. The 25/5 rule tells you two burras to focus your attention and your capital. It forces you to concentrate on your very best ideas. But a network of interconnected models is required for true mastery. This system of prioritization is only as powerful as the quality of the ideas you put into it. And the video that is now appearing on your screen is the next essential piece of that puzzle. It is the link that connects the what to the how. It's the blueprint for the next level of this strategy, the next component of the mental arsenal you are building. The average person will click away now, satisfied with this one piece of knowledge, ready to return to a state of distraction. But you are not the average person. You understand that success is not an event. It is a process of continuous learning and system building. The journey to becoming a truly sophisticated decision-maker, an architect of your own financial future, continues with a single, deliberate click. You've learned how to focus. Now it's time to learn what to focus on. Complete the map. Continue the ascent. The choice, as always, is yours.